Welcome to The Explainer. Today, we're diving into something that's literally the foundation of financial trust: audit evidence. It's what stands between a company's claims and what's actually real. So let's get right into it.
All right, here's our game plan. We're going to start with why evidence is so critical for trust. Then we'll open up the auditor's toolkit to see the techniques they use. We'll look at how they bring in outside voices for backup, how they hunt for patterns in the data, and finally, and this is the big one, we'll break down the hierarchy of evidence. At the end of the day, auditing really boils down to one simple but massive question. How do we actually know that the numbers a company reports are real? The answer, 100% of the time, is the evidence. It's the bedrock that the entire financial system is built on.
Really think about that for a second. When a massive company says it has billions of dollars in assets, how does an auditor prove it? You can't just take their word for it, right? There has to be a rock-solid method for gathering objective, cold, hard proof.
So, if you can't just trust what the company says, what do? Well, you open up the auditor's toolkit. Think of these as the fundamental techniques every financial detective uses to get to the bottom of things. Let's take a look at what's inside.
First up, you have the most direct, hands-on evidence you can possibly get: physical examination. This is where the auditor literally goes out and touches, inspects, or counts a tangible asset. We're talking about them being in a warehouse, counting boxes, or in a vault, verifying cash. It doesn't get much more real than that.
Next in the kit, we've got recalculation. And it is exactly what it sounds like. The auditor basically becomes a human calculator. They'll take a sample of the client's math, like adding up a stack of invoices or checking a depreciation schedule, just to make sure that 1 + 1 actually equals 2.
Now, this one sounds similar, but it's a little different. It's called reperformance. Here, the auditor isn't just double-checking the math. They're actually rerunning an entire process from scratch. So if the client has a specific way they age their accounts receivable, the auditor will redo that whole procedure themselves to see if they get the same answer. It's like rerunning the experiment to verify the results.
Then there's observation. This is all about the auditor using their senses to see what's really going on. They might tour a factory to get a feel for the operation, or watch how employees actually conduct an inventory count. It's kind of like being a fly on the wall, just to see if the company's processes are happening the way they say they are.
Of course, you've got inspection. This is that classic detective work, following the paper trail. It means digging through all kinds of records and documents: contracts, invoices, shipping logs, board minutes, basically anything, whether it's a physical piece of paper or a file on a server that can back up a transaction.
And last but not least in the toolkit, there's just asking questions. This is called inquiry. It's a huge part of the job, getting information directly from the client. And this is a big but, we're about to see why an auditor can never rely on this alone. You always have to verify.
So, getting information from the client is one thing. But what's way, way better? Getting that same information from a totally independent outside source. This is how an auditor takes their case from pretty sure to absolutely certain.
And the main way they do this is called confirmation. So instead of asking the company, "Hey, how much cash do you have in the bank?" the auditor goes straight to the bank and asks them directly. Instead of asking the client, "Who owes you money?" they go to the customer and confirm the balance. You're going straight to the source to see if the stories match up.
Okay, so beyond looking at individual pieces of paper or assets, auditors also have to zoom out and look at the big picture. They use data analysis to find patterns, look for relationships, and, most importantly, spot any anomalies, things that just don't add up.
These are called analytical procedures. The basic idea is to look for relationships in the data that are plausible, that just make sense. For example, if a company says its sales went through the roof, you'd also expect its shipping costs to go up, right? If sales skyrocket but shipping costs stay flat, well, that's a huge red flag that something's not quite right. So how do they spot these patterns? Well, they usually make 3 key comparisons. First, they compare this year's numbers to last year's numbers to check for consistency. Second, they compare the actual results to what the company budgeted or forecasted. And third, they see how the company stacks up against its competitors in the same industry.
And all this analysis isn't just for fun, it's incredibly powerful. It helps the auditor get a deep understanding of the business, it can flag if a company is in financial trouble, it points directly to potential errors or misstatements, and it can even make the whole audit way more efficient.
Okay, so we've seen all of these different tools an auditor can use, but now we get to what is maybe the most important concept in all of auditing.
And that is not all clues are created equal. Some evidence is just flat out better than others. This brings us to the evidence hierarchy.
And this hierarchy is actually pretty intuitive. At the very top, the absolute most reliable evidence is anything the auditor figures out for themselves, like when they physically count the inventory or recalculate a loan payment. In the middle, you've got solid evidence from independent outsiders, like a confirmation from a bank. And down at the bottom, the least reliable evidence is information that comes straight from the client, like the answers they give to questions. Now, these tools aren't just used randomly. They have a specific place in the audit process. Analytical procedures, for instance, are required right at the beginning, in the planning phase, to get the lay of the land, and they're required again at the very end as a final check. In between, during the main testing phase, the auditor uses that whole toolkit we talked about to gather all the proof they need.
So in the end, all these procedures, this whole hierarchy, it's all designed to provide proof. But since an auditor can't possibly check every single transaction, it leaves us with a really important question to think about. In a world this complex, where do you draw the line between verifying everything and just having to trust?